everyone, it's Tim Mackey with Vista. I wanted to spend a little time with you today and talk about the methodology of handling client case cost, both from an accounting standpoint, an IRS standpoint, and a management standpoint. There's been a lot of confusion, a lot of different ways to account for your advanced case costs. These are the costs that we invest in our cases. Items such as the med records costs, expenses for experts, etc. The direct cost involved with handling a case. Some firms deduct those costs as paid and then recognize revenue as they're collected back from the client at the resolution of the case. And if the case is lost, it's just an expense. You never pick up that revenue. The IRS honestly does not like that method. They say that that those expenses are not current operating expenses, that those expenses or expenditures are really an asset, that you are in effect loaning money to your client, and therefore those costs should be captured and carried on your balance sheet. Now, for those non-accountants, what does that mean? That means that you don't get a current tax deduction or see those expenses show up on your profit and loss statement on a monthly basis. They're actually carried on another statement called the balance sheet as an asset, that is a receivable back from your client. So at the resolution of a case, you collect that money. If it resolves positively, obviously, you collect that money and you simply pay off the receivable from the client. Therefore, it's not a tax deduction for you. Included in your taxable income when it comes back. When you expend the money, it's captured on the balance sheet. It is not a tax deduction for you. These two methodologies are, in my opinion, very important for a couple of reasons. Number one, you're in compliance with the IRS when you treat them as an asset on the balance sheet, as a receivable. There's some argument from the Ninth Circuit or from some firms who happen to fall in the Ninth Circuit, which is out West California, Oregon, Nevada, etc., where there was a ruling that said if you had a gross fee contract that you did not have to capture these items on your balance sheet. But a gross fee contract is when you do not include that you have the right to collect on the expenditures. You just simply take a percentage of the case exclusive of your investment in the cases. Frankly, I have not seen a contract or an agreement or retainer agreement that says that. The ones that I've seen with the clients we've worked with all have a provision that say that we're going to expend money on your case and we have the right to recover that money at the end. So therefore, we're loaning you money. So in my opinion, again, it is a loan. The IRS agrees with that. And again, I want you to know I'm not an IRS agent. I'm on your side, but that's the proper accounting treatment for that. Another reason that I think it's important to capture these expenditures that way on the balance sheet as a receivable is that I believe that if you do capture it on the profit and loss statement, it can cause misleading information. What I mean by that is this, is if you're in a growing firm and you're investing more and more money in your cases, then you are showing an inflated expenditure, an expense on your financial statement that says, hey, we're investing in cases and we're deducting it and therefore lowering your bottom line profit. I believe that's misleading in this case because you're investing in cases that are ultimately going to resolve in your favor. If not, you're not going to be in business very long. But the management information that we get when you capture those expenditures on your profit and loss can be misleading. I think you can see that. It inflates your current expenditures and doesn't give you a true picture of profit and loss. Again, this is something that I'm a little bit passionate about because I want management information, and I think you want management information ongoing throughout the year. Some clients of ours say, hey, we want to keep our books for tax purposes. Well, my belief is, and the truth is, that you pay tax one time a year and you manage all year long. So we can make an adjustment at the end of the year if you want to continue to carry it on your P&L. But for management purposes, I absolutely believe that we should look at this as a receivable and therefore have a better profit picture. I do want to bring something else up here too that has to do with firm cash flow. If you think about this and you are utilizing your own money to finance these case costs, in other words, you are the one that's investing in the cases. In a growing firm, you're putting more and more money out on those cases. You can be extremely profitable, but you're taking every profit dollar and investing it in the cases and therefore can create a cash flow problem. I am not an advocate of debt, but sometimes using someone else's money to advance those case costs, a bank, some other type of financial instrument where you are borrowing that money and then in effect loaning it to your client with a matching of what you've borrowed and what you've loaned, does not affect your cash flow. That I believe is a much better way to run your business. And in most states, you can actually pass along the interest cost on the money you're borrowing. Just use a mirror. If you're paying 5%, then you're charging 5%. Most states do not allow you to make money on that transaction, but it's a very interesting way to maintain cash flow. And I know this is carrying you through some information on case costs fairly quickly. If you want to know more about this, feel free to give me a call anytime. You can visit our website and get my contact information. And would love to talk to you more about it if you're interested. Thank you so much.